How are ETFs different from mutual funds? Both mutual funds and ETFs are great options for diversifying a portfolio, but they have some key differences. ETFs are usually passively managed, tracking specific indexes, and they tend to have lower fees, which is a big plus. They're also traded on exchanges, making them feel more flexible. However, mutual funds can be appealing for those who like the idea of active management. With mutual funds, you're essentially trusting the asset manager to try and outperform the market, though the higher fees reflect that. The decision between choosing an ETF or a mutual fund really comes down to your specific investment goals, personal preferences, and how your portfolio is structured. It's always a good idea to consult with your financial advisors before making any decisions. As for me, I personally lean towards mutual funds because my focus is on trying to outperform the market in the long term. There are certain mutual funds that have shown strong performance over time, and I believe that the merits of active management are strong. If you're interested in exploring this, it's worth reaching out to a financial advisor that you trust to see which funds and which ETFs might be a good fit for your strategy.
So ETFs and mutual funds both provide diversified exposure to a range of assets, but they also differ in several critical ways. Number one, costs, right? This is the biggest difference, right? ETFs, they offer much lower management fees due to their passive nature in terms of how they invest versus mutual funds, which are typically much more actively managed. So for example, a Vanguard S&P 500 ETF or the ticker called VOO has an expense ratio which is as low as 0.03%, whereas many actively managed mutual funds that track the large cap US market can still charge north of 1 to 1.5% as management fees. These higher fees in mutual funds can significantly erode the returns over time, especially in the long run. Number two, the trading flexibility. ETFs, they trade on exchanges throughout the day like stocks, so allowing investors to buy or sell them whenever the markets are open. This intraday trading enables quick reactions to the market movements, which unfortunately for mutual funds is not possible because they're priced only once a day at the NAV, meaning investors can only buy or sell them at the end of the trading day. Number three, and I think one of the most important factors is, the active management and the underperformance of actively managed mutual funds. There are numerous studies that have shown that actively managed mutual funds, they tend to underperform their respective benchmarks over time. According to a 2023 SPIVA report, 80% of large cap mutual funds, they underperformed the S&P 500 over the last 10 years. In contrast, ETFs, especially index tracking ones, like the WOO ETF that I quoted earlier, or a globally diversified ETF such as MSCI World iShares Core ETF, they closely track their benchmark index, offering much more reliable performance without the drag of the active management. Number four, minimum investments. ETFs are hugely accessible for retail clients because they can be brought in very small quantities. Investors can purchase a single share if they need. Mutual funds often come with a higher minimum investment threshold. With platforms such as, say, Saif, investors can now buy ETFs in small fractions, making them highly accessible. In summary, ETFs offer lower costs, greater trading flexibility, and a reduced risk of underperformance compared to actively managed mutual funds, making them an attractive option for investors.